to a more it's not dissimilar to a mortgage in that respect. For many people, especially people whose balances are lower than their incomes, the 10-year standard plan is likely to be the cheapest plan over time. It might not be the lowest monthly payment, but the name of the law, if you're playing the long game, the name of the game is to pay the least amount out of pocket over time. And for many borrowers, that's going to be by utilizing the standard 10-year plan. Now, if you consolidate your loans through the federal government and you don't actively pick a different plan, they will also put you on something called the standard plan. And it works the same way as the 10-year standard plan, only instead of being over 10 years, it's going to be over between 12 and 30 years. Now, how much your balance is when you consolidate is what determines the term of the consolidation. Essentially, if you consolidate 60,000 or more, you're going to have a 30-year term. And under the standard plan for a consolidation loan, they're going to figure out how much you have to pay every month to pay it off within that 30 years. Once again, remember, the longer you take to pay, the more you're going to pay in interest in most cases. The graduated repayment plan is, again, sort of self-explanatory. They're going to put you, if you're in the graduated repayment plan, they're going to give you an interest-only payment for the first 2 or 4 years, and then the payment is going to gradually increase year to year, and you're still going to pay it off within your original term. So if you're under a 10-year term, if you've never consolidated and you go on the graduated plan, the first 2 years or so, your payment's going to be about half what it would normally be because you're only paying interest. And then every year after that, it's going to go up, but you're still going to pay it off within the 10 years. Similar scenario, a consolidated loan can also get the graduated repayment plan, but of course, it's just a longer term. The extended repayment plan is a way to extend the term of the loan without actually consolidating. The extended repayment plan is for borrowers who owe at least $30,000 total amongst all their federal loans, and it'll extend the term of the loan to 25 years without actually having to consolidate. Now, some people ask me, well, why would you bother doing that? Why not just consolidate? There's some people that their personal strategy for repaying their loans is what we call the avalanche method. The avalanche method means paying the minimum on all your loans, but throwing extra money at the loans with the highest interest rates first. Not consolidating and utilizing the extended repayment plan is a way to maintain that flexibility where you can target a loan with a higher interest rate to send extra money to if you should so choose. If that's not your strategy, and it's easier for you to just you want the longer term to get the lower payment, consolidation might be a better way to go for that reason. Now, all federal student loans, whether you have Stafford loans or whether you have Parent Plus loans or whether you have a consolidation loan or a Graduate Plus, whether your loans were made under the direct loan program or the older federal family education loan program, also known as the FEL, they're all eligible for these plans. The only loans that aren't eligible for these plans are loans that are in default. Any other loan, doesn't matter, they started making federal student loans actually technically back in the late 50s, but you still have an open student loan from say the 60s or 70s, bless you, but you are eligible for any of these repayment plans, assuming that your loans are not in default. Now, the downside is that if you're pursuing forgiveness under either the Public Service Loan Forgiveness Program or the forgiveness that's baked in to the income-driven repayment plans that we're going to talk about extensively in a little bit, none of these plans other than the 10-year standard plan will be considered an eligible payment under PSLF or the income-driven plan forgiveness. So that's it. 6 minutes or less, I've just given you all the details about the bucket of plans that we call the non-IDR plans. Um, Again, your payment under these plans is going to be based exclusively off of whatever your loan balance is and whatever your interest rate is. So this was the easy section. Now we're going to get into the more complex section, which is our other bucket of plans, which are the income-driven repayment plans. Now, as I mentioned, these plans are confusing because they're all exactly the same except where they're different. In fact, as you can see in front of you, two of them have exactly the same name, but completely different terms. So the granddaddy of the income-driven plans that's actually utilized by a decent number of people is what we in the industry called old IBR. Old IBR was put into practice around 2009. And whether you have the older Federal Family Education Loan Program loans or whether you have direct loans, then you are potentially eligible for this plan. Parent Plus loans are not eligible for old IBR. As you'll see in a minute, actually, Parent Plus loans in most cases aren't eligible for any of the income-driven plans other than income contingent. But anyway, old IBR is the only one that's available of the income-driven plans that's available to those older FFEL loans. By the way, if you're not sure if you have FFEL or direct loans, the easiest way to tell is look at when you took the loans out. If you took all your loans out after July 1st of 2010, and they're either Stafford loans or graduate or Parent Plus or consolidation loan, then it is a direct loan for sure. That's because they stopped making FFEL loans as of June 30th of 2010. If you took your loans out prior to July 1st, 2010, the easiest thing to do is to log on to your servicer website and look to see how the loans are listed. Most of the servicers, if they're FFEL loans, it'll say FFEL in front of the loan type. If it's a direct loan, it'll say direct in front of the loan type. So it'll say direct Stafford loan, or it'll say FFEL Parent Plus loan. The next IDR plan I want to mention is new IBR. As you'll see in a little bit, new IBR has actually very different terms than old IBR, but that plan is only available to direct loan borrowers. Same for the pay-as-you-earn plan. Then we have what used to be called repay, and effective this past July is now called the save plan. That is also only for direct loan borrowers. And then we have the real grandpa of the income-driven plans, which is ICR, or income contingent repayment. That was actually made available back in 1994, but hardly anybody ever used it. And that's because for two reasons. One, back then, most people had FFEL loans, not direct loans. And number two, even today, for many borrowers, ICR tends to be the more expensive of the income-driven plans, which is why it's not, even though it's the oldest, excuse me, it's not particularly popular. Now, as I alluded to earlier, one thing that ICR has that the other income-driven plans don't is it actually is somewhat easily available to our poor Parent Plus borrowers. Parent Plus borrowers do have to consolidate to get access to ICR, but they only have to consolidate once. A little later in the presentation, I'm going to tell you about a loophole that's temporarily available to Parent Plus borrowers to potentially get access to the lower cost income-driven plans such as SAVE. I should have asked earlier, Addison, before I get into the real nitty-gritty about the income-driven plans, were there any questions about the other bucket, the non-IDR plans, that you think I should cover?
Nope, no questions so far.
Oh, you guys need to put him to work. Okay, thank you. All right, so let's get into the nitty-gritty about the income-driven plans. And I'm going to start out by defining some terms that are common amongst all the plans. The first term I want to define for you is discretionary income. Now, we've all heard the term discretionary income before, but it means something very specific when you're talking about the income-driven repayment plans. Discretionary income is the amount of your income that they're going to use to calculate your payment under all the IDR plans. Now, discretionary income is defined as your adjusted gross income minus a percentage of the poverty level that's based on your family size and state. Now, if you're married and you file your taxes as married, your AGI is going to be both your AGI as well as your spouse's AGI. If you're married and you file your taxes separately, then they will only use you, the borrower's income in the calculation. Now, the exception to that is for community property states. If you're married and in a community property state and you file your taxes separately, they're gonna your income is your AGI is going to be 50% of the total income of you and your spouse. Now, the percentage that they're going to subtract from your AGI, the percentage of the poverty level, differs amongst the plans. For income contingent, they're just going to use 100% of the poverty level based on your family size and state. For old and new IBR, as well as pay as you earn, they're using 150% of the poverty level. And for the SAVE plan, they're using 225%. So it's by far the most generous subtraction from your AGI under the SAVE plan. For those that might be curious, prior to July, when the SAVE plan, when repay was converted to the SAVE plan, the repay plan also used 150% of the poverty line based on your family size. Now, the poverty level, if you live anywhere other than Alaska and Hawaii, the poverty level based on your family size is the same amongst those 48 states. California, I'm sorry, Hawaii and Alaska have a slightly higher poverty level based on the family size and state. All right, so let's take a look at how discretionary income works in the calculation. So this example that you see in front of you is one I'm going to use throughout the rest of the presentation, just to hopefully try to add clarity to how these plans work. And by the way, for those of you at this moment going, oh, ma'am, they didn't tell me there was going to be math. I hate math. Don't make me do math. You don't have to do math. There are plenty of calculators out there that are going to do this for you. But I find that showing you the math is really the best way to understand how the programs work and how the payments are calculated. So if you take your adjusted gross income, and let's pretend that we're looking at either old IBR, new IBR, or the pay as you earn plan, which uses 150% of the poverty level. So they're subtracting that amount. So in our example, we have a borrower whose AGI is 62,000. They're living in Maryland and they have the family size of 4. So 150% of, I'm actually in this case using last year's poverty level. This year's is a little bit higher. The poverty level for a family size of 4 living in Maryland was 26,200. 150% of that is 39,300. So what they're going to do for this borrower is they're going to take their AGI of the 62,000, subtract 150% of the poverty level, which is the 39,300, and that leaves us with 22,700. Now, to determine their actual monthly payment, they're going to divide that by 12, and then depending on which payment plan it is, either multiply it by 10% or multiply it by 15%. The exception to that is income contingent repayment. You're going to see as we go on that ICR just in general is the redheaded stepchild of all of these plans. But for the rest of them, so if they were on either new IBR or pay as you earn, they'd multiply that by 10%, and that gives them a payment of $189 a month. If they're on old IBR, they're going to multiply that by 15%, and that will give that borrower a payment of $283. Now let's look at the new SAVE plan, and I think you'll see why the White House and this Department of Education has been touting it so much. Now that the repay/save plan actually takes 225% of the poverty level, Let's look at that effect on the same exact borrower with the same exact income and family size. So we've still got an AGI of 62,000, but now we're taking 225% of that 26.2, which turns out to be just a little under 59,000. That leaves a balance of 3,050. You divide that by 12, it's $254.16. You multiply it by 10%, which is the current calculation for SAVE. And this borrower who last year's payment, let's pretend COVID didn't exist, last year's payment would have been $189. This year, that same borrower, that payment's only $25.41. That's a huge, huge impact. Now, come next July, for any amount of this borrower's loans that are from undergraduate school and are not double consolidated parent plus loans, they're actually going to reduce that percentage even more to 5%. So if we assume that all of this borrower's loans, all 62,000, is from undergraduate school and they have none of it is graduate loans, their payment's going to further decrease to just $12.70. So again, a borrower whose pre-COVID payment was around $189, without making any other changes to their income or family size, next year that payment will only be $12.70. So it really is, again, the new SAVE plan really is having a huge impact, especially on lower income borrowers. For borrowers that have both graduate and undergraduate loans, for the SAVE plan, they're going to do a weighted average of the two. So let's say you owe 100,000 in student loans, and 50 grand is undergrad, and 50 grand is graduate. The calculation, they'll do it on 7.5%, because again, they're going to do a weighted average once they reduce that percentage next summer. All right, so excuse me. The next common term I want to describe for you is called partial financial hardship, or PFH. Having a PFH is required to initially get into some, but not all, of the income-driven plans. Now, what's important to note is that if it's a plan that requires that you have a PFH to get in, that also means that there's going to be a cap on how high your payment can go under that plan. For the plans that don't require you to have a PFH to initially get in, that also means that there's no cap to how high your payment could possibly go under those particular plans. Now, a PFH exists when the annual amount due on your loans, if you were to use the 10-year standard repayment plan, is higher than what your payment would be under the plan that you're applying for that's requiring the PFH. So if you're applying for old IBR, if your payment under a 10-year standard plan would be higher than 15% of your discretionary income, then you would be considered to have a PFH and would be potentially eligible to access old IBR. For new IBR and pay as you earn, of course, it's as we saw on the prior slide, it's 10% of your discretionary income. And a PFH is not required to enter into income contingent repayment or repay/save. So let's put this into practice. Let's look at our same borrower that we were working with on the prior slide. Now remember, this borrower has an AGI of 62,000. They have a family size of 4 and they're living in Maryland. Now let's assume that they owe 60,000 in federal student loans. So a $60,000 loan is going to have a payment of around $720 a month under the 10-year standard plan. Now, whether you're good at math or not, I think we can all agree that $189 is a lower amount than $720, as is what was the other one? $283. Both of those numbers are lower than $720, which means that our hypothetical borrower does have a partial financial hardship and is therefore potentially eligible to enter into either old IBR, new IBR, or pay as you earn. And again, a PFH is not required for the SAVE plan or income contingent. All right. So we've defined all the common terms. The next thing I want to do is talk about each plan individually and holistically. After that, we're going to compare and contrast the plans with an actual example. Before I go into each individual plan, I want to check in with my friend Addison and see if there's any questions on what we've covered so far that you think could use some further clarity.
No, not at this time, Betsy.
Okie dokie. All right, let's do this. All right, so let's talk about old IBR first. As a reminder, old IBR is the only plan under the bucket of income-driven plans that FFEL loans are eligible for. I also want to remind you that Parent Plus loans, unless they've gone through this double consolidation loophole, are not eligible for old IBR. Now, old IBR uses 15% of your discretionary income. You are required to have a PFH to get into IBR. And like all the income-driven plans, it has a baked-in forgiveness component of its own. And that is if you're on the plan for at least 25 years and you still have a balance, that balance will be forgiven. Now, a common question we always get when I get to this part is that forgiveness taxed? Right now, the answer is no. Congress put a temporary moratorium on the federal taxability of income-driven plan forgiveness through 2025. Unless they extend that moratorium on the taxability of that forgiveness, and I encourage all of you to write your members of Congress and encourage them to do so. But if they don't, and you get forgiveness under any of the IDR plans starting in 2026, it will be taxed as income. Now, the next question I get after that is less of a question and more of a freak out. How am I ever going to be able to pay a tax bill that high? Well, you're not. It's taxed as income. That doesn't mean that if you get $100,000 forgiven, doesn't mean your tax bill is going to be $100,000. To oversimplify things, on average, you'll be paying 37 cents on the dollar, which is still a lot less than you would have paid out of pocket if you paid the entire loan in full yourself. In many cases, especially for borrowers who have very low income compared and very high loan balances. So don't let the potential, as some borrowers call it, tax bomb, discourage you from pursuing the forgiveness baked into the income-driven plans. Again, it's about paying the least amount out of pocket over time. Now, let's talk about the interest subsidy. With the exception of ICR, all of the income-driven plans also have somewhat of an interest subsidy if your payment is lower, if your calculated payment on the income-driven plans is lower than what your monthly interest is. Now, for old IBR, and actually everything except for the SAVE plan, it's a fairly limited subsidy, but hey, something's better than nothing. And the way it works is that for the first 3 years you're on any of the income-driven plans, they look at the amount of interest that's accruing on just the subsidized Stafford portion of your loans. And if your calculated IBR payment is less than that, they're going to waive the difference. So just for simplicity's sake, let's pretend that all you have are subsidized Stafford loans and you're accruing $100 a month in interest, and your calculated IBR payment is $50 a month. Once you make that payment, the government is going to waive the other $50. But they only do that for the first 3 years, and they only do it for the subsidized portion of your loans under old IBR. One thing I want to mention about, sorry to jump back and forth, but one thing I want to mention about the forgiveness component of all the income-driven plans is that in this respect, all the IDR plans sort of cross-pollinate. So you don't have to be on the same income-driven plan to accrue the 25 years that you would need, for example, to get forgiveness under old IBR. So if you and your counts do not reset if you change plans. So if you're on old IBR for say 10 years, and then because of the melodious sound of my voice, you decide to change over to save tomorrow, you'll still have that 10 years under your belt towards the 20 or 25 years you'll need for forgiveness under the save plan, or the 20 years you need for pay as you earn or new IBR. All right, speaking of new IBR, let's talk about new IBR. So new IBR is only available to direct loan borrowers, and once again, not Parent Plus borrowers unless they've been double consolidated. It's only available to borrowers who have no borrowing history prior to July 1st, 2014. So if you have loans prior to July 1st, 2014, even if you've since consolidated them, you are not eligible for new IBR. Now, they are also in the process of sunsetting the new IBR plan. So for borrowers that, and this is not effective till next summer, but if you're on the repay/save plan for at least 5 years, doesn't have to be a consecutive 5 years, but you're on it for at least 60 months. And at that point, you try to switch over to new IBR, they're going to deny you. And the reason for that, as you'll see when we get to the save plan, is they're trying to make sure there's not a loophole for borrowers with graduate loans to be able to get the benefits of the save plan and then still get forgiveness faster than they would under the save plan. So that's why if you've been on save for at least 5 years, you cannot get into new IBR after that. So the payment calculation for new IBR is 10% of your discretionary income. You are required to have a PFH to get into it in the first place. The interest subsidy is the same as old IBR. It's 36 months and only on your subsidized loans. But the forgiveness component of new IBR is 20 years instead of the 25 years that's required for old IBR. Pay as you earn is the fraternal twin to new IBR. Payment calculation is the same, PFH is the same, interest subsidy is the same, forgiveness is the same. The only difference is who is eligible for it. Whereas new IBR, you have to have no borrowing history prior to July 1st, 2014. For pay as you earn, you have to have no loans made prior to 10/1/07, and you have to have at least one disbursement of a loan on or after October 1st, 2011. I know that seems oddly specific. For those of you wondering why it's so oddly specific, the short answer is budget. The pay as you earn plan was done via executive order under the Obama administration. The other thing about pay as you earn is that they are really sunsetting this plan. If you are not actively on pay as you earn on July 1st, 2024, you will never be able to get on it. Even if you were on pay as you earn on June 30th, but then you switch to something else after that, you can't get back on pay as you earn. And the reason for that, again, is to try to prevent the loophole of the forgiveness loophole that I'm going to talk about. I'm going to point out to you in just a minute when we get to save. So again, new IBR, pay as you earn are fraternal twins. The only real difference is who's eligible for it and how old your loans have to be. Old IBR, doesn't matter how old your loans are. You could have loans from 1960, and if you want to get on old IBR, they will welcome you with open arms and then ask you why you're not getting on the save plan instead, because it's probably cheaper. All right, let's get into the plan that most of you are probably here to hear about, which is what used to be called the repay plan and is now called the save plan. Now, only direct loans are eligible for this, and Parent Plus loans are not, unless they've gone through the double consolidation loophole, and that has been done. That loophole is closing July 1st, 2025. The payment calculation, as we mentioned before, is 10% of your discretionary income until July 1st, 2024. And then on or after that date, they'll use 5% of your discretionary income for any portion of your loans that are undergraduate. They'll use 10%, they'll continue to use 10% of your discretionary income if you only have graduate loans, or if you only have double consolidated Parent Plus. And if you have a little of everything, they will take a proportionate percentage of the undergraduate and graduate loans. So it'll never be more than 10%. You are not required to have a partial financial hardship, but that also means that there's no cap on how high your payments can go. For the plans that do require PFH, the cap is no matter how high, if you stay on that plan and don't actively leave it. So that's old IBR, new IBR, and pay as you earn. If your income jumps up to $4 million a year, your payment will still not ever be higher than what it would have been if you were on the 10-year standard plan. So if we go back to our hypothetical borrower who has a $62,000 AGI, they owe 60 grand in loans. So we know they do have a PFH. We figured out that they do have a PFH. So depending on when their loans are made, they'd be able to get into old IBR, new IBR, and pay as you earn. Let's say next week they got a fabulous new job and they are making $4 million a year. If they don't actively leave those plans, their payment will never get above $720 a month. But under repay/save, as well as income contingent, because there's no PFH requirement to get in, if you start making $4 million a year, then your monthly payment is going to be 10% of whatever the discretionary income is for $4 million a year. So your payment, there's no limit to how high the payment can go. Now, here's where it gets good. The interest subsidy for SAVE. Under the SAVE plan, they are going to forgive 100% of the difference between whatever your calculated SAVE payment is and the amount of interest you're accruing on all of your loans under the SAVE plan. And they're going to do that. They're going to forgive the difference. And they're going to do that for as long as you're on the plan. Now, for all of these payment plans, including SAVE, if your income is very low, it's possible for you to have a $0 payment. So let's say you owe $200,000 in loans and you get a $0 payment under the SAVE plan, and you have a $0 payment for the full 20 or 25 years. You will never pay a penny in interest for that period. The government will forgive it all. And then they will, in that scenario, they'd end up forgiving the entire balance after the 20 or 25 years. A more common scenario is, let's say you're accruing $200 a month in interest and your payment's $100 a month. Your calculated payment's $100 a month. Then the government's going to pay that other $100 for you once you've made your SAVE payment. Now, a common question I get asked related to this interest subsidy is, well, what happens if I pay more than my calculated payment? Will it go to principal? And the answer to that question is yes. Paying extra on your loans does not reduce that monthly interest subsidy. Now, it does reduce your principal balance, which reduces how much interest is accruing every day and therefore every month. But that's no reason to not pay extra if your strategy is to pay the least amount over time and pay the least amount of interest. The interest subsidy is not immediate. We have some borrowers sort of freaking out right now saying, I'm not getting my interest subsidy. It's not immediate. We know it's going to be applied. Once this whole repayment restart chaos shakes out, it'll likely be applied on a monthly basis. So don't freak out if you don't, if you made your payment today and you don't see the interest subsidy tomorrow. It'll happen, I promise. Now, the forgiveness component for the SAVE plan, This is where those sunsetting of those other two plans will start to make a little bit more sense. You may not like it, but it'll at least make a little more sense. So if all you have is undergraduate loans, you never ever borrowed even $1 in loans for graduate school, and you never even borrowed $1 in Parent Plus loans, the forgiveness component for the SAVE plan is going to be after 20 years on the plan, or 20 years under a combination of the plans. Remember, all the IDR plans cross-pollinate with each other as far as the forgiveness count goes. Now, if you even had $1 in graduate loans, the forgiveness is going to be after 25 years. Now, common questions we get there. So I only owe a little bit in graduate loan debt, but I owe a lot in undergraduate. If I pay off my graduate loans, will my forgiveness go down to 20 years? And the answer is no. Once you have the graduate loans, it's forever tainted. It will always have, they will always count the fact that at one point you did have graduate loan debt. But this does explain the sunsetting, because what they don't want people to do is be on the SAVE plan for, say, 19 years to take advantage of the lower monthly payment, and then in year 19 apply for either new IBR or pay as you earn, so they can get their forgiveness in 20 years instead of the 25, because they have graduate debt. So that's why they made those sunsetting provisions for those other two plans. Now, starting next year, there's another piece of the forgiveness that's going to be implemented. And this is for borrowers whose original total balance on their loans was $12,000 or less. If you fall under that category, they will, and you're on the SAVE plan, they will actually forgive your loans in 10 years instead of the 20 or 25. Now, to be clear, this is the 12 grand is based on the total amount you originally borrowed. So if you borrowed three $5,000 loans, you borrowed more than 12 grand, and this doesn't apply to you. You borrowed 15 grand. If you borrowed 20 grand, but now you've paid it down to 11, and then you consolidate, you still don't fall under this category because you originally borrowed the 20 grand. Now, the good news is that this provision is not like a cliff. It's more like a slope. So let's say you didn't borrow 12 grand, you borrowed 13. That doesn't mean that you have to wait 20 years to get forgiveness. It means you have to wait 11 years. So they're going to add a year for every $1,000 you borrowed over the 12K. They're going to add a year to the forgiveness timeline, but it'll never be more than the 20 or 25 years. So hopefully all of that was clear as mud. I do still have one more IDR plan to draw out for you, but before I do, let's check in with Addison. How we doing? Questions, comments, gripes?
It's been a slow day. We're good.
Okay. All right, let's talk about ICR, which is not only the oldest income-driven plan, but also, as I mentioned before, I call it the redheaded stepchild, because this one is probably the most different, and in many cases the least generous of the income-driven plans, but it has its place. So ICR is only available to direct loans. ICR is also the only plan that Parent Plus borrowers can access without going through the nonsense that is the double consolidation loophole. They only need to consolidate once and they can get on ICR. Calculation is where it gets a little squirrely. It's not nearly as transparent as the other ones are. Excuse me. For ICR, they're going to use either the lesser, they're going to use the lesser of 20% of your discretionary income. Now, unfortunately, ICR, if you remember from our prior discussion, ICR, they only use 100% of the poverty level. It's the least generous in that regard as well, to determine your discretionary income. But they're going to, on top of that, they're going to take 20% of that to be to calculate your payment. The alternative calculation they're going to do is figure out what you would have paid if you were on a 12-year plan. So just like the 10-year standard plan, but over 12 years instead. and they multiply it by this sort of obscure thing called an IPF, or an income percentage factor. That's something that's published every year, updated every year, much like the poverty level is updated every year. So they're going to do both of those calculations, 20% of the discretionary income, and then the 12-year standard plan multiplied by this IPF. Whichever comes out lower, that's your payment amount. Now, here's where it gets interesting. Because of that second calculation, the whole 12-year standard plan thing, if you have a very high income compared to what you owe in loans, ICR actually turns out to be the lowest monthly payment under the income driven plans. So where that is really helpful is, let's say you're pursuing public service loan forgiveness, and you've been a rock star, and you've gotten all kinds of promotions, and now you're making oodles of money, but you only have like a year's left of payments left to get forgiveness under public service loan forgiveness. And because your income's jumped up, the SAVE plan is higher than even your 10-year standard plan would be. Or in that scenario, it could be ICR will give you a much lower payment to, again, help you pay the least amount over time before you get that forgiveness component. You don't need a PFH to get in. That also, of course, means that technically there's no limit to how high your payment could go, but there really is, because of that 12-year standard plan calculation. Unfortunately, there is zero interest subsidy under ICR, and the forgiveness component is after 25 years, either under ICR or a combination of the plans. All right, so that's the down and dirty of all the individual plans. I'm going to go over a couple sort of good to knows, and then we're going to see what that looks like in practice. Now, as a reminder, if you're married and you file your taxes as married, they're going to use both spouses' incomes in the calculation. However, if you're married and file your taxes as married, and you both have federal student loans, they're also going to use both your loan balances in the calculation. They're essentially, what they do in that case is they look at both your loan balances, they look at both your incomes, they do a single calculation based on your total income, and then they split that amount into two. They do basically a weighted, they proportion it between the spouses. So it doesn't mean your income gets counted twice, it means it only gets counted once. For many married borrowers, unless there's a huge difference between each other's income or each other's loan balances, continuing to be married and filing together, and both of you getting on an income-driven plan, will often result in the lowest payment total in the household. So it's something to explore. If you file your taxes separately, as I mentioned before, they are not going to use your spouse's income, but that also means you have to reduce your family size by one. They don't let you have your cake and eat it too. If you're excluding your spouse's income, you can't include your spouse in your family size, which means that your the poverty guideline they're going to be using for you is going to be lower. We talked about PFH, we talked about the spouse. All right, let's talk about the forgiveness component. Now, I am going to talk about this one-time account adjustment that's going to happen between now and this time next year. But it's important that that's a one-time only thing. And going forward, rather than the people that are going to get forgiveness sort of like right away under that adjustment, you need to know and conform with the traditional IDR rules. Now, for forgiveness, you do have to be on an actual income-driven plan for all 240 or 300 months, 240 being 20 years, 300 being 25, in order for the balance to be forgiven. Any payments made under the 10-year standard plan will also count towards the 240 or 300. Now, it used to be, if you consolidated, it would reset your income-driven plan count back to 0. That's no longer the case. If you consolidate by the end of this year, because of that one-time account adjustment, they'll actually give you the highest count of all your underlying loans. If you consolidate after that date, and your loans have different periods of eligible payment, they're going to do a weighted average. So let's say you have 50 grand in undergraduate loans and 50 grand in graduate loans, and your undergraduate loans have been in repayment longer than your graduate loans, so they have 100 counts under their belt towards IDR forgiveness, whereas your graduate loans only have 50. If you consolidate them together, they'd end up with a count of 75 if you're doing it after December 31st of this year. If you do it by December 31st of this year, so just a couple weeks left, the count would be that 100, which is the higher count between the two. As I mentioned, you don't have to be on the same IDR period the whole time. Your IDR payments don't need to be consecutive. Where you work and who you work for doesn't matter for IDR forgiveness. It does for public service loan forgiveness, but does not for IDR forgiveness. We don't care who makes the payment. It could be your employer. If you have Parent Plus loans, it could be the child that benefited from the Parent Plus. They don't care. But on the flip side, they're always going to base the payment on the IDR plans off of the actual borrower's income, not on the income of who's making the payment. All of your eligible loans are required to be on the same plan. So if you're thinking, well, I'll just use pay as you earn for my graduate loans and save for my undergraduate, no. You are required to be on the same plan for all of the loans that are eligible for that plan. And of course, any payment that counts towards IDR forgiveness also potentially counts for public service loan forgiveness, assuming that it was made on a loan that's eligible for PSLF and you were working qualifying employment at the time. Now, when they're counting your 240 or 300 payments, here's what they're looking at. Here's what counts and here's what doesn't count. So as I mentioned, any payment you make under any income-driven plan will count towards the 240 or 300, even if it's a calculated $0 payment. Effective next year, they're actually going to let defaulted borrowers in a very, very limited way utilize income-based repayment. And once they do, they will count those. Other than that, any payments made in default will never, ever count, including under the waiver I'm going to talk about. Now, effective this year, they're also going to count towards the 240 or 300 any period you were under a cancer treatment deferment, a deferment for being in a rehabilitation program, unemployment deferment, economic hardship, or military service. And starting next summer, they will count periods of forbearance that are specific to being involved with AmeriCorps or National Guard, if you're under Chapter 13, 7, or 11 bankruptcy, but only in scenarios where you're required to make payments, which I believe only happens under 13. And then there are things called administrative forbearances that borrowers actually have no control over. They're put on the accounts by the Department of Education for things like delayed processing in an IDR application, or maybe you are applying for a disability discharge. There's many reasons that administrative forbearance can be put on an account. Starting July of next year, they will count those periods of administrative forbearance. They're actually technically counting a lot of them now because of some of the servicing errors that are being made since repayment restart. All right, that's all I have for the repayment plans. Before I get into the one-time account adjustment, checking in once again to see if there's any questions about traditional IDR rules.
No, ma'am.
Okay. You guys are taking it easy on us. All right. So the current administration has actually done quite a bit to try to provide relief to some of the more vulnerable borrowers. And one of the ways they're doing it is through this, what we're calling the one-time IDR adjustment. So at a high level, what they're doing is they're assuming that if everybody knew about the income driven plans back to 1994, they would have been on them. And they're assuming the reason you weren't on it is because either the industry as a whole didn't do a good job communicating their existence to you, or maybe you were misled by your loan servicer. So they're giving everybody the benefit of the doubt. And sometime between now, and they've already started, they started this fall. They're doing this in batches, and they expect to be finished with all 40 million plus accounts by this time next year. They are going to go into every single direct loan account and look back at every month that was ever in a repayment status, as well as some other statuses, and they're going to give you credit like you had been on an IDR plan. So someone who's never been on an income-driven plan, ever, but they've been in repayment for 30 years, they're going to get immediate forgiveness, because they'll look back at their repayment history and see that there were 20 or 25 years of payments under their belt, and they're going to give them immediate forgiveness. In fact, they've already done that for about 900,000 borrowers. For everybody else, like let's say you've only been in repayment for 8 years, but you've never been on an income-driven plan. When they get to your account, all of a sudden one day you're going to wake up, and even if you've never been on an income-driven plan, it's going to show that you have 8 years of payments already under your belt. Now you can do with that with what you will. Some people won't make any sense to change plans. Their strategy might still be to pay their loans off aggressively, because that's what's going to cost them the least amount over time. For other borrowers, it might make sense to get on an income-driven plan now so they can accrue the rest of the payments that they need. Because going forward, basically anything after today is not going to count under the adjustment. So you'll have to be on an IDR plan to accrue IDR payments. And of course, that always dovetails with PSLF. Anything that's an IDR payment, including something that has its fairy godmother wand tapped over it and has all of a sudden made an IDR payment, it also will count for PSLF, assuming, all the other PSLF stuff applies. So how do you know if you're going to get this adjustment? If you have a direct loan, you're getting the adjustment. There's even some Feller Perkins loans that are directly held by the Department of Education that are going to get this adjustment without having to do a darn thing. Essentially, if your loan got the COVID pause, so if you had a 0% interest rate and no payments due between March 2020 and August of 2023, you're getting the adjustment. If you have a Fell or Perkins loan that's not directly held by the Department of Education, which most of them are not, you have to I don't know why I keep looking at that slide and failing to update the drop dead date for this. It was May 1st. It's now December 31st. So if you consolidate your Feller Perkins loan by December 31st of this year, it doesn't have to be completed. You just have to have submitted the completed consolidation application. Then you will also get this adjustment, and that includes Parent Plus loans. Now, they are going back to July of 1994. So if you've been in repayment since the 80s, they will count back to 94, but no earlier than that. As I mentioned, if once they do the adjustment, it shows that you've made the 20 or 25 years needed, you will get immediate forgiveness. And there's almost 1 million people that already have. As long as you consolidate by 12/31, it will not reset your count. And as I mentioned earlier, if you have loans that have different counts, if you consolidate by 12/31, they will give that consolidation credit for the highest count. We already talked about all of this. If once they do the adjustment, you not only have forgiveness, but it looks like you actually have more than the 240 or 300 payments needed, or in the case of PSLF, 120, they're going to send you a refund. We have seen, Addison and I, quite a few borrowers that not only get the pleasure of showing a $0 balance, but gotten very fat checks from the U.S. Treasury in the mail a couple months later. Now, if your overpayment happened post consolidation, I'm afraid you're not going to get a refund. But if your overpayment, if there was no consolidation at all, or if your overpayment happened after the date of a consolidation, you will get an automatic refund. Speaking of the word automatic, this adjustment's automatic. There's no application for it. It's just going to happen. Same for the refund. You don't have to apply for the refund. If you're eligible for it, they're just going to send it to you. Just might take a minute. Now, on the flip side of that, there is nobody. Don't call your servicer and ask them when the adjustment's going to happen on your account. Don't call your servicer and ask them when you're going to get your refund. They can't answer that question. The adjustments are being handled by the Department of Ed. The refunds are being handled by the U.S. Treasury. Don't call them either. They can't tell you when the adjustment or the refund is going to come. I will be the first to tell you it's unfortunate and frustrating that this is an informational black hole, but it is what it is. There is no way to get your refund or adjustment done any faster, so please don't file a complaint or call your member of Congress. And just to be clear, I'm usually a big fan of those strategies when warranted, but there is not a person on the planet that can get your the timing of your adjustment moved up. The fact of the matter is, no one borrower is more important than another. So I get that there's some people that might be darn close to forgiveness or really anxious to know how high their count is. I get that. But there just isn't, they are not entertaining any fast tracks for anybody. And quite frankly, from a fairness perspective, that's sort of how it should be. As I mentioned, they have started applying these waivers. Right now, they're focusing on the people that they've identified who might get immediate forgiveness, because so we call them long haulers, people that have been in repayment for a long time, or people that might have already submitted proof of 10 years of eligible employment for public service loan forgiveness. I think starting with the next batch, which will probably be around January, we might start seeing more people get an account adjustment that won't result in immediate forgiveness, but we'll get them darn closer to it. Now, once this project is done, you will be able to see they're going to implement a counter on studentaid.gov. And so you'll be able to see how far along you are as time goes on after this, there and on your servicer's account. Okay, really quick, I know we're getting close to time and we wanted to talk a little politics before we get off. I just want to show you a quick comparison of what the different repayment plans look like. So back to our mysterious anonymous borrower, they have an AGI of 62,000, family size of 4. Since we've been talking about the waiver, they've moved from Maryland to California. They owe 60 grand. Their interest rate is 5.5%. If you go to studentaid.gov and use what's called the loan simulator tool, this is where you don't have to do any of the math. It does all the math for you. It's awesome. You just plug your numbers in once and it tells you what your payment will be under all the plans you're eligible for. And more importantly, how much it's going to cost you out of pocket. One thing to know, this calculator assumes you're just starting repayment. So if you've already been paying for 10 years, it's just going to assume that you haven't. It's going to start you from scratch. So you might have to do a little of the math on your own. So in this scenario for this borrower, their payment under the SAVE plan would be 0. And they'd pay a total of $35,000 out of pocket and get forgiveness after 20 years. The reason it shows 0 to 425 is that the calculator assumes that you're going to get like a cost of living raise every year. So it's making assumptions about what your payment will be on an annual basis. Because remember, you have to recertify your income on an annual basis under the IDR plans. Under the 10-year standard, their payment would be $651, and they'd pay back almost 80 grand out of pocket. Under ICR, the payment would be $533, and they'd pay back $82,000. So this is a no-brainer for this borrower. They clearly should go on the SAVE plan, not only from a monthly expenses standpoint, but from a how much they're going to pay out of pocket standpoint. just to show you what the other plans might look like, graduated repayment, which is interest only for the first few years, they'd start off at 370, and in the end, their payment would be 1,200 a month. Pay as you earn and a new IBR, their payment would be 142, and they'd pay back 90 grand. The extended plan, which is the one that extends the term to 25 years, the payment would be 368, and they'd really pay back a lot. And then extended graduated, which is interest only, and then a 25-year term, they'd pay back 274 and then 120. Now let's look at what happens if that borrower's income doubles. In that scenario, their payment under the save plan is 438, and they're going to pay back 82,000 out of pocket. But if they get on the 10-year standard plan, their payment will be a little higher, but they'll save themselves $4,000 over time. So again, when you're comparing the plans and trying to budget, you want to budget for the long term as well as the short term. Now, if none of these plans work for you, maybe you have a temporary high medical bill or a car repair, a temporary solution is to ask for a forbearance or a deferment, which will completely postpone the payments for six to 12 months. That's a very limited solution. Interest still accrues during these periods, and they, for the most part, don't count towards forgiveness. Anytime you make a payment, it always goes to interest that's accrued as of the day you made the payment first, and then the rest of it goes to principal. Of course, the exception to that is if you have a $0 payment under the save plan, where all the interest beyond your calculated payment is waived. In that case, your payment will eventually go all to principal. There's never a penalty for paying extra or early. And you're allowed to change repayment plans at almost any time or as often as you need to. A couple of quick things about the current quote-unquote on-ramp period we're in. So the Department of Education, we all knew going in that after a 3.5-year pause in every single borrower entering repayment at the same time, that things might be bumpy. So they created this so-called on-ramp period that runs through the end of September of next year. Essentially what it means is if you should go delinquent on your loans, now normally they report you as delinquent to the credit bureaus if you're 90 days delinquent or more. They're not doing that through September 30th. Now, it doesn't mean you're not past due on your payments if you don't pay. Doesn't mean interest won't still accrue. You'll lose your interest subsidy for the various income-driven plans if you don't pay. You'll still get delinquency notices. You'll still get delinquency phone calls. They're just not going to report you as 90 days delinquent or 180 days delinquent on your credit report. They're also not going to let anybody default during this period. The other thing they're doing is they're making sure that nobody has to recertify their income-driven plan at least until March. Now, one of the big bumps in the road we've seen is some of the servicers. So borrowers, if you were on an income-driven plan before or during COVID and didn't actively get off of it, you should still be on that income-driven plan now. We have seen some servicers for no reason kick people off and then ask them to submit a new income-driven plan certification to get back on. They should not be doing that. If that happens to you and they tell you the only way to fix it is to submit a new form, politely escalate the call. If that still doesn't work, email me via TISLA, please, through the TISLA email, which is tisla@freestudentloanadvice.org. Department of Ed is actively digging down and resolving some of these errors. All right, that's what I have for you. Here are the resources to all the things that I mentioned to you during this presentation. We still have a few more minutes. So if you have more questions, absolutely throw them into the Q&A, or if there's other questions or other topics that people want to talk about, I'm happy to talk about them.
Betsy, why folks are thinking about last minute questions. I do have a couple of the policy questions for you. So just wanted to get your thoughts. Folks might have heard in the news that that the Department of Ed is doing these rulemaking sessions. Not, I don't expect everybody else to be really following the nitty-gritty policy details. So could you just share with folks what the purpose of that is, what the goal and what we're hoping the outcome of that process is?
Yeah, so I do love me a good neg reg. So the particular negotiative rulemaking session that is about to have its third and final meeting next week is the Biden's administration's attempt at sort of a second bite at the apple of the broad loan forgiveness. So I think most people within the sound of my voice were probably closely following the administration's attempt to do 10 or 20,000 in loan forgiveness for borrowers who had incomes of 125,000 or less, more if they had also ever received a Pell Grant. And the Supreme Court said no. So the Biden administration said, "Oh, well, let's try it. Let's go a different path." And this path is through negotiated rulemaking. If you had asked me this question a couple days ago, I would have said, we've got some sort of vague outlines of the way they're thinking of going about this. But since then, in the last couple days, they've issued their next version of draft regulatory language to be discussed next week. Now, to be very clear, this is a draft. A lot can change between now and anything that may or may not get implemented. So do not make any financial, family, pet decisions based on what I'm about to say. But it appears like they want to be able to provide forgiveness in most cases up to 10 or 20,000, just like what they were trying to do with the first bite of the apple that didn't make it through the Supreme Court in certain scenarios. So one of the scenarios is going to be borrowers they owe more now than what they originally borrowed. And they're enrolled in an income-driven plan. And their adjusted gross income is equal to or less than 225% of the poverty line based on their family size. So to put that into real numbers, if you are a single person with no dependents, so you have a family size of 1, and your balance is higher now than what you originally borrowed, and you're on any income driven plan other than the SAVE plan, you'd have to be making less than about $33,000 a year in order to get this $20,000 forgiveness under this particular provision. Now, for borrowers under the SAVE plan, it's sort of the same thing. Your balance is higher than what you started, but you're on the SAVE plan instead of one of the other income-driven plans. In this case, they're going to forgive up to $20,000 as well, but they're using the same income guidelines as they did the first time around. You have to be making less than $125,000 a year for a single person, $250 for a married couple. The reason that it might seem less generous for people on the SAVE plan is because of sort of the generous benefits, I think, already offered within the SAVE plan. Some of the other things they're considering are borrowers that have been in repayment for over 20 or 25 years. So essentially the IDR waiver, essentially permanently putting into place sort of the IDR waiver. But most of the people in that situation are going to get looped in when they do the one-time IDR adjustment over the coming year anyway. But they seem to be wanting to make that permanent in case they miss anybody or anybody slips through the cracks. They also want to be able to apply full forgiveness to people that should have been eligible for forgiveness under something else, such as total and permanent disability discharge or closed school discharge. But for whatever reason, they slip through the cracks there. They want the ability to sort of just apply full forgiveness in those scenarios. So that seems to be the direction they're going in. where we go from here is once they do the final meeting next week, we'll be waiting for the notice of proposed rulemaking with the draft regulations, which normally wouldn't come till around July. I'm predicting April. I heard from you, Megan, that you think it might be May based on something in the OPM. And then we'll probably get the final rule. I suspect late summer. Put it this way, before the election, I think we'll get the final rule. Do I think it'll be challenged in court? You betcha. I do think it'll be challenged in court. Unfortunately, I think people are just waiting to submit those documents. It's a very political policy issue.
Yeah, it's definitely unfortunate that so much of this has gotten tied into politics. But on that note, and I want to be respectful of your time and everyone who's been with us. Let me get a little political here and say, we've been talking about what this administration is currently doing and what they have the potential of doing. I saw that there's been a question about, could all of this change with the new administration? And so one, I just want to share with folks on the call, a lot of this really does stress how important the elections are. It is incredibly important. But Betsy, in addition to the administration, do you see any student debt relief potential happening through Congress?
Not in the near future. I'm not gonna sugarcoat it. This administration has done more for especially the most vulnerable student loan borrowers than any administration in my career, and I have been doing this since the earth cooled. And unless we got a very heavily weighted Democratic Congress, both pieces of that, and unless the deck was really loaded, I don't see it.
And that, coming back to one of the questions that someone was asking about whether this would change under a new administration, that's why we're seeing the administration going through this negotiated rulemaking process, correct? That it has the force of law, some of the changes that they're looking to make for the future, the administration?
Yeah, I'm glad you asked that question. So one of the things that it's important to remind people is that we have a president, not a king. And the president of the United States, in most scenarios, is required to follow federal law. Now, the COVID pandemic loosened up those rules. It allowed because of the state of emergency, it allowed the president to do certain things that were not within federal law. But for the most part, they have to follow federal law. Negotiated rulemaking doesn't change that. Negotiated rulemaking is the process that federal agencies use to change federal regulation. Federal regulation also cannot be contrary to federal law. And that's where when the challenge comes, that is going to be the challenge. The challenge is going to be that these new regulations are contrary to federal law. Now, whether that's true or not is for people much smarter than me to make a decision on. But negotiated rulemaking is the way that the Department of Education is required to make changes to regulations.
I appreciate you providing some insight as to how this is all moving. So, Betsy, I want to thank you for all of the work that you and Addison and your team over at TISLA has been doing on this issue. I want to also remind everybody who's on the call that if you do have specific questions, Addison has put the email address in the chat so that you can continue to reach out to Betsy and Addison and their team for that specific help. This is a lot. There has been so much that has gone on with student debt. As Gloria Blackwell mentioned at the beginning, AAUW is aware of how impactful the burden of student debt is, especially for women and for all people, and for and for their families. So I really do appreciate you all working with us, with our audience. And I just want to reflect that your organization, that you do help individual borrowers with individual cases, with specifics, and just to be able to share today what some of the information was about the overall plans, what's changed, what people have, what their options are, is incredibly helpful. So thank you again, and want to see if you had any closing words, and then
I
we'll.
do. I do encourage, again, TISLA was founded to provide free student loan advice to borrowers. So I do encourage you to go to our website, freestudentloanadvice.org. I'd like to think that we have everything there in plain English. So before, sending us your question, you might want to take a minute to look at our repayment plan page or our deferment page or our PSLF page to see if I did a better job explaining it in writing than I just did for you on this webinar. I also wanted to give a shout out. One of my most important career mentors is here, Janine. Hello, Janine. So I wanted to give a shout out to her. I would not be here if it wasn't for her.
And also, just to give a little more kudos, Janine Greenwood is one of our state public policy chairs with AAUW in Virginia. So for all of our member leaders who are with us today, I really appreciate that. And I think I want to make sure that we don't cut off while Addison is responding to one more question. But yes, and the question really is about whether your organization helps with specific details. I want to thank everybody who spent some time with us this afternoon. And for everybody who's registered, because I know this came up a couple of times, this is a lot of information, and we're going to share it back with everybody. The information on this resources page, the link to the recording, so that you all have that and can really think through what works for your situation, and know that TISLA is still will continue to be a resource even after this phone call, after we conclude this webinar. But Betsy and Addison, thank you so much. And thank everybody for being here this afternoon, and best wishes to everyone.
Thank you.
Thanks.